What do we think, Dan? I mean, we got a CPI number coming. We have an election, but these stocks are all at much more reasonable prices than in any time in recent memory. Does that mean that investors can start nibbling at these now, or do we have to wait and see what happens for the next 3 months?
Joe, good morning. I think there are select opportunities at current levels. Certainly the list of concerns, be it inflation, cyclical headwinds, softness in parts of the consumer, they're real. But I think as we get into 2023 and as the year ahead progresses, people will see and the market will begin to price in visibility on a return to growth. So if you look at a company like Amazon, certainly the holiday season is going to be a little bit softer than people had thought a few months ago. But I think they're delivering value in key areas like Prime, AWS, or Amazon Web Services. Their cloud platform remains healthy and strategic. And so we like that name here. And if we look at Google or Alphabet, even though there are concerns about spending in the near term, the results demonstrate core search is durable. They, too, have a cloud platform which is doing well. And so we like that name. And I'll round it out with Microsoft. It's not that they're not immune from cyclical headwinds, but they are executing well. Our discussions with their customers in key areas like cloud with Microsoft Azure suggest that they're doing a good job helping customers really build out this digital infrastructure. So we see opportunity here at current levels, Joe.
So what was the average multiple for big cap tech, Dan? And what is in this environment we're in right now? Rising rates, I don't know what the terminal rate is. What should a reasonable multiple be? And then what type of growth over the next couple of years, annual growth, are we looking for? I'm just trying to assign what a reasonable multiple will be for these companies to try to decide whether they're cheap now.
We look at a variety of metrics, Joe. Ultimately, our focus is on the free cash flow generation of these businesses and the growth rate of that free cash flow over the next few years. So multiples for some of them have come down from above average, above the S&P 500 in the 20s down into the teens in some cases. I think the valuation is reasonable at current levels, but our bigger focus is really on the innovation and the growth drivers. I think the market will decide what multiple it wants to assign. But if companies like Amazon and Alphabet, Microsoft can return to double-digit growth in the out year, late 23 and really 24 and 25, I expect earnings and free cash flow to be higher, and the multiples will also likely be higher. But I think these can still be good investments, even if the multiples stay relatively low, assuming they grow.